Hey everyone, my name's Anthony, and I'm a corporate guide here at Northwest Registered Agent. Today we're going to talk about non-cash expenses. So what are non-cash expenses? Kind of what it sounds like. It's any cost that your business does not pay for in cash. So why would you want to record them? Well, it gives you a better long-term picture of your business's health, and many of them are also tax deductible. So let's take a look at some examples now. So the first one we're going to look at is depreciation. So depreciation is the amount that tangible assets such as equipment or property decrease in value over time. So we have this example. Let's say you purchased equipment worth $15,000, but that price is decreased to $12,000. So your depreciation value is now $3,000. So this is usually a tax deductible item, but you're going to want to refer to the IRS guidelines for further instructions. The next one, amortization. So it's like depreciation, except it applies to intangible assets like patents or trademarks. So you're just going to divide the original price of the asset by how many years you expect it to be useful. So let's look at this example. So let's say you purchase a patent for $50,000 and you expect to use it for 10 years. Your amortization would be $5,000 per year. The next example we're going to take a look at is resource depletion. So resource depletion is the decrease in value of any natural resource. So for example, if your company owns a coal mine, the mining property will lose value over time as coal is extracted from that property. The next one we're going to take a look at is stock-based compensation. So many companies give employees stock options as either an incentive or reward. So to calculate the expense, you're going to multiply the number of stock options issued to an employee by their fair market value. So the example we have here, let's say 100 stocks are issued to an employee at $10 per share. The expense for this is $1,000. So the last example we're going to look at is provisions for bad debt. So if you make sales on credit, you run the risk of either partial payment or no payment at all. So money that goes unpaid by customers is referred to as bad debt. Most businesses estimate the amount of bad debt they will have in an accounting period. So let's take a look at an example of what this might look like. So let's say you run a furniture store and you allow customers to make monthly installments. You could estimate that your sales revenue will be 10% lower than accounts receivable due to bad debt. If the accounts receivable amount is, let's say, $120,000, your provision for bad debt will be $12,000. If you found this video helpful, be sure to like it and subscribe to our channel. If you have any questions, go ahead and drop them in the comment box below. And remember to call Northwest when you want more.